Welcome to the Curate Investments Exhibiting Our Investments Artist webinar. Today we will explore the theme of investing in possibility, and you'll hear directly from two of our handpicked investment managers, Sesfikile Capital and Momentum Asset Management. But before I introduce the managers, on the 1st of August this year, Curate turned 1, and I'd like to extend a heartfelt thank you for the support that you've shown us over the last year. When we founded Curate, we weren't just building another investment manager. We wanted to reimagine what it means to invest in a world changing at a rapid pace. We wanted to make sure our clients had access to the very best investment managers from around the world. Since our official launch, we've transformed Curate from an ambitious vision into a growing community of investors who believe in our approach, and a team who shows up every day to make investing more personal, more human, and more powerful. At our core, we have not taken our name or our guiding principles lightly. Our principles are anchored by the fact that to curate is to choose carefully. There's a fundamental difference between assembling and curating. Assembling often means more data, more options, more complexity. It's additive by nature. Curating, on the other hand, is selective. At Curate, the essence of what we do is we handpick the best people to take care of your money. As a global business, we research managers worldwide to find the people we believe are most suited to delivering on what you require. Curate's disciplined and rigorous selection process seeks out outstanding investment teams, wherever they may be in the world. We're thrilled to be able to bring you investment management pedigree from New York, Boston, London, Rotterdam, Cape Town, and of course, Johannesburg. Through these partnerships, we're able to offer our clients access to single managed unit trust funds, which offer client-led solutions. This includes reliable income solutions, capital growth strategies, and both hard currency and rand-denominated options. The cash and income funds managed by Momentum Asset Management are ideal for clients seeking capital preservation, liquidity, and income. Our balance fund, managed by Visio Fund Management, blends growth and stability for medium to long-term objectives. Our property and equity funds, managed by Sesfikile Capital and Laurium Capital, respectively, are designed for long-term capital growth needs, and both have a combination of local and global assets. Robeco's Global Sustainable and Emerging Market Equity Funds, also available as feeder funds, offer broad-based, developed and emerging market equity exposure at a low cost. And the Global Value, Growth and Quality Equity Funds provide clients with exposure to different equity styles, managed by distinctive asset managers based internationally. In summary, this is the Curate fund range. Each Curate fund is managed by one specialist manager, ensuring focus and precision. Today we'll unpack more about the Curate income and property funds to introduce you to the people behind the strategies. So please feel free to ask them any questions in the Q&A section, and our speakers will address them in real time or respond after the session. Before I hand over to our portfolio managers, I have the privilege of introducing Mandy Wiener. She's one of South Africa's most respected journalists and authors, celebrated for her credibility and incisive storytelling. She currently hosts the Midday Report on 702 and Cape Talk, writes a weekly column for EWN, and has authored several award-winning and best-selling books. Welcome, Mandy. I look forward to your inspiring stories.
Well, thank you so much for joining me as I try and give you a little bit of perspective about South Africa and where we are at the moment, because it's very easy to fall into that default negative narrative about South Africa and what our story is. My name is Mandy Wiener. I'm a working journalist, so I do a radio show every day on 702 and Cape Talk. I write books and I do TV shows and I write a weekly column. My job every single day is to tell people what's wrong with the country. Literally, I speak about crime and corruption and malfeasance and wrongdoing and targeted assassinations and hold power to account. And that is literally my job every single day, is to be negative and to tell people all of the bad stuff about South Africa. So it would be very easy for me to stand before you and talk for an hour about all things negative about South Africa and why you should not invest, why you should tell your clients not to invest in South Africa. But the reality is that I see the very worst of it every single day, but I also see the very best of South Africa as well. And it's so important for us to have that balance. It's what I like to call light and shade when it comes to the news and the reporting, because it can be a news cyclone, not a news cycle in South Africa, and it can be really, really overwhelming. But I do find that we tend to have quite a binary view in South Africa. Everything's either terrible or everything's great. And we tend to have a parochial view about South Africa, that everything is much worse here than it is anywhere else in the world. So how are you feeling about South Africa? What's the zeitgeist at the moment? If you have to use one word to describe how you feel about South Africa, what would it be? Think about it. Write it down. Are you feeling anxious? Are you feeling unsure? Cautiously optimistic? Encouraged? Whatever it might be. And I imagine everybody would have a varied experience and your words would all differ. But I do this a lot and speak to people a lot, and generally the sense out there at the moment is people are feeling unsure, that there is a degree of uncertainty. There are global headwinds out there that we would all like to turn into tailwinds, and there's a lot going on with US tariffs and inflation and the currency. There's a lot going on at the moment. So South Africa can be this roller coaster that we ride, where one day we are encouraged, where the Springboks or Bafana Bafana or the Proteas may win, and often sentiment is driven by sport. That's literally what the data tells us. And then there's days where we could have really bad load shedding, or we could have some kind of weather event, or something terrible might happen, or you hit a pothole on the way to work, or the traffic lights don't work. Although in Joburg, they are working now because we're getting the G20, but nobody knows how to use them because we haven't had traffic lights for so long. But South Africa really is this roller coaster that you ride, where there are days where you hope and there are days where you despair. And that does make us be more negative. Our sentiment can be really, really negative about where we are as a country, and 8 out of 10 South Africans at the moment feel that the country is not going in the right direction. 8 out of 10 South Africans. But I think it is so important that we understand that the grass is not always greener on the other side, and the whole world is crazy right now. It doesn't matter what country you're in or what country you're going to. I think that it's important to have some perspective about where we are, right? Because everyone's got their problems. Every country has got its own set of circumstances, its own difficulties. And we're really seeing a world that is out of kilter. We're seeing increasing polarization. We're seeing a rebalancing of global trade forces as well. And it means that it can all be a bit much because we're all trying to navigate the chaos that is out there. And that's why it's so important in the media space to have credible, trustworthy, reliable journalists to help you navigate. So people are often looking to try and work out who to trust. Who do you trust in a world of chaos and misinformation and disinformation? In a post-truth world, who do you look to for guidance? Who are the shepherds that are going to help you navigate your way through this world? And they look for credible journalists, and it's really important that we build that trust. And very similarly, your clients will be looking to you to help guide them through the morass out there, the chaos, the frenzy, the uncertainty of the world. And it's so important to maintain that trust relationship and to also balance your perspective about how you see things, because your clients will be looking to you to try and understand what's going on. And as I say, we do tend to fall into this default negative narrative, that single story of South Africa, that everything is broken, nothing works, everyone is corrupt, you have to pay somebody off to do business, that you shouldn't invest, it's much safer offshore, and our currency is unreliable. And I love this quote from the Nigerian author Chimamanda Adichie. She speaks about the danger of a single story. And the danger of a single story is not that it's not true, but that it becomes the only story that we tell. And that's very much what has happened in South Africa, that we only tell this one story, that there is massive unemployment and poverty. We have such a high crime rate, that corruption is rife. And it's not that those stories are not true, but they are not the only story that we should be telling about South Africa. I like to speak about what I call the hope dealers in South Africa. And these are people that are changing the narrative, people that are pushing back against this single story. These are the good civil servants that are doing their jobs properly. They are the investigative journalists, the active citizens, the whistleblowers, the judiciary, people who are trying to change the story that we tell about South Africa. I love this quote from Pravin Gordhan as well, in which the late Public Enterprises Minister speaks about how there is a war taking place every single day in South Africa between those who want the country to thrive and those that want to corruptly enrich themselves. And this is so true. It's happening in every single state-owned entity. It's happening in the private sector. It's happening in SMMEs. It's happening at grassroots level. In every law enforcement agency, there are people that are trying to get the country to work and to fly and to soar. And then there are those that are trying to benefit themselves and are turning to organized crime or turning to some kind of dark forces to try and corruptly enrich themselves. And it's so crucial that we bolster the good forces, the superheroes, the hope dealers that are trying to get things to work in this country. And I think a big part of that is going to be collaboration. It is going to be the work that is being done between the public service, government, the private sector, and civil society. And we have a really strong civil society in South Africa. We have a really strong private sector as well. And I think that's where we are going to find the sweet spot of getting things right, is through this collaboration. The work being done by Operation Vulindlela is really encouraging. So for those of you who don't know, of course, Operation Vulindlela is a joint project between Treasury and the Presidency and the private sector. 3 separate work streams that have been set up. One is crime and corruption, one is logistics, and the third one is energy. And a JSE listed CEO heading each of these work streams. And over the past few years, we've seen real progress, real tangible progress. The lifting of the generation cap for independent power producers, as an example, the backlogs at Home Affairs with visa reforms, some of the privatization of the corridors on the rail network and the backlogs at the ports, the collaboration between some private law firms and the NPA, the building of a forensic center as well. So real tangible progress being made by Operation Vulindlela, and part of the reform agenda by the Government of National Unity that is being continued through this administration. Phase 2 of Operation Vulindlela sits in municipalities. So that's where the focus is going to be, on municipalities going forward. So we've seen real work post-state capture to try and restore, rebuild, recapacitate state-owned entities. And I don't think anyone truly appreciates the extent of the evisceration that took place at state-owned entities, at parastatals, during the state capture era. What we saw was a deliberate, intentional, malicious campaign to hollow out these institutions. And we've had to work incredibly hard to try and recapacitate and rebuild them. Transnet recently coming out with results saying that they foresee a profit for the first time in years in 2026. We've seen the backlogs at the ports, obviously an issue when it comes to trade, those being worked on. Eskom is a primary example. Dan Morakani at Eskom and the work that has been done there. We haven't had load shedding in over a year. And that means that our economy is, to an extent, liberated by the effectiveness of state-owned entities. It has also been buoyed by the fact that we now have independent power producers that are contributing to the grid. And there is so much opportunity here for South Africa in the renewable energy market, and the fact that we are really seeing a focus on wind, on solar, and the potential that's there for South Africa through the lifting of the generation cap, the increasing contribution by independent power producers, by a lot of the big mining houses and manufacturers that are now contributing to the grid, all of that easing pressure on the electricity supply in the country, which makes it much easier for the economy to run. So there is a lot of possibility there for us to be focusing on. We've also seen some of the big gaps from government being plugged by civil society and active citizens. In every single instance where there has been a failure of leadership, we have seen government being supported by active citizens and by civil society. And that's crucial because we cannot leave it to government alone. We need to be responsible corporate citizens, but as individuals, we also need to be active citizens by supporting NGOs. And I love the stories of individuals that are running feeding schemes or are offering extra maths or science classes in their communities on weekends, and people that are really rolling up their sleeves and making a difference. There are also really good people that are working in the public service. And that single story tells us that there are no good advocates, that there are no good police officers, they're all broken, all the good ones have gone to the private sector. But I promise you, there are pockets of excellence, and there are people that are really doing a great job. Have you watched Rosemary's Hit List? If you haven't, you absolutely should, because it is the craziest quintessential South African story. Rosemary's Hit List on Showmax tells the story of Rosemary Ndlovu. Rosemary Ndlovu was a police officer on the East Rand in Joburg. She killed 6 members of her own family to claim the life insurance money. People remember the story of Rosemary Ndlovu, but they don't necessarily remember Captain Keshi Mabunda, who was the investigating officer on that case. Keshi Mabunda was sitting in a police station one day, and he saw Rosemary Ndlovu come in with a pile of documents, and she was getting these signed off by one of his colleagues. And he said, "What's going on here?" And he realized that there may be some dodginess afoot, and he took that docket and started investigating. For 2 years, Keshi Mabunda investigated Rosemary Ndlovu. She tried to kill him. Ultimately, she was charged, she was prosecuted, she appeared in court with the best hair you've ever seen, and she was sent to jail. Keshi Mabunda was the police officer of the year in South Africa last year. And he's now busy with another case similar to that, where he's investigating another person that took out life insurance policies and killed their own family members. It just goes to show that it takes one person that does their job properly to make sure that there is accountability to change that narrative that we're so quick to tell about the police. And there are a lot of people in this country that are seeing opportunity in the chaos, that they are looking for possibilities to invest in. And you just have to look at the Kasi economy in South Africa, the informal sector. And there's been a lot of debate recently about the extent of the informal sector, what that means for our unemployment numbers in South Africa. Of course, we have massive unemployment, over 70% unemployment amongst young people in this country. But there is the argument that it could be much lower because of how many people are hustling out there. And the suggestion is that because there are so many people that are working in the informal sector, that it just goes to show, because there should be a lot more social unrest in this country if unemployment was as high as it really is. And I'm speaking here about the woman who is selling amagwinya at the taxi rank, the landlord who is doing backyard rentals, or the woman who runs her home bakery and supplies local stores, the spaza shops. And the estimation is that that is an industry that is worth billions, literally billions of money that is going through the informal sector. The taxi industry is estimated at 50 billion rand. The spaza shop industry between 150 and 200 billion rand. The backdoor rental industry, the backyard rental industry at about 30 billion. So there really is this can-do attitude in South Africa, where even if people can't find formal employment, they are finding it in the informal sector, that they are making things happen, that they are hustling. And there are incredible stories in this country of entrepreneurs who see the possibilities in this country, who see the opportunities, who are going out there and are making things happen. And that's why we really need to see a reduction in regulations, in the red tape, in the bureaucracy, because this is the heartbeat of our economy. People who are really doing everything they can, in spite of their circumstances, to make the economy work.
Today on our Waking Up feature, we are spending time with Happiness Makhamele, a thriving entrepreneur from Alexandra.
Yes, so Happiness runs a local enterprise that specializes in African food, with everything from amatombole to fat cakes being the most popular on her menu indeed. You should try some. I promise you, you'll love it.
This is me now. Admin. Yeah, so you can see Gutama roles are much different from driving to stock. Now I'm checking on my orders. I've got people working for me. I've got ladies in there. I've got guys that are coming through just now. So not only are we only nizama ukuthi imindeni eminingi iphile ngeMoving Feast. Akuphile umndeni wami kuphela. You know, we've got people that have been with us more than 8 years. Hoping that you can also grow and fast track other things like more contracts into our sales, ensuring that we pay for salaries, we pay for the space, you know, and we also have a footprint in the country. See myself being that other catering company beyond, you know, not just we are a kasi and then we is small business. I don't want to be labeled like that forever.
And it's people like that that are really the heartbeat of the economy, that are keeping the economy thriving and moving, even when growth is so slow and stagnant and our economy is stuck. It's the informal sector for me that is keeping things going. And that's because we are hustlers, we are entrepreneurs. A report came out last week which tells us that South Africa is the most entrepreneurially minded nation in the world. They've used what's called a grit index, and the grit index measures how people are making things happen, their resilience, their determination, and South Africa is miles ahead of other countries when it comes to entrepreneurs and being industrial and seeing those opportunities where it really just looks like crisis. So I do think that it's very easy to fall into that default negative narrative and to be pessimistic. There are a lot of reasons to be pessimistic about South Africa, and it's very easy to focus on those. I know all about them. Trust me, my view is not just Pollyanna, that everything is great and rose-tinted glasses. Of course, we have problems. I can speak to you about that ad nauseum. But I think it's also important for us to have that light and shade, that balance, that perspective that comes through when you also seek out the positive stories, and they are there to tell. And I'm definitely sensing an increase in positive sentiment in the country. New car sales, for an example, we had 51,000 new car sales in August. We are seeing a little bit more money coming into the economy with interest rates coming down, inflation still above that 3% target as well. But we're starting to see equities. The Rand had the best August on August movement for the last 20 years against the dollar. So there are some positive signs that we're starting to see around the economy at the moment and the turnaround for the country. And I think we need to acknowledge our problems. We can't be naive, and I'm certainly not naive about them. But I do believe that South Africa is a country worth fighting for. I believe that there is so much potential, so much possibility in this country that I really think that it can be better than what it is now. And there are great opportunities and possibilities to be investing in. I recently spent about an hour and a half with President Cyril Ramaphosa for a book that I'm releasing about the GNU negotiations. And it was fascinating to talk to him, to get a sense of where the country is going, where the government is going at the moment, and crucial that we do have this collaboration, this consensus leadership in terms of taking the country forward. There are real concerns around stagnant growth and unemployment, and a lot of this off the back of trade with the US and the tariffs that have been imposed post-Liberation Day. And that's going to be a big test going forward, is how we deal with that as South Africa and how our leadership deals with that. In his State of the Nation address last year, the president spoke about the Ndlulamiti scenarios from the Mapungubwe Institute. And what the Ndlulamiti scenarios are three different scenarios looking to what South Africa could be in the future. So they speak about the Hadida scenario, where everyone just makes a lot of noise and nothing really gets done, and we complain, but there's no remedy to the situation. And then there's the vulture scenario, where we see superinflation, higher unemployment, civil unrest, more corruption, and service delivery even poorer, the rand devaluing. So that's the kind of worst case scenario for South Africa. And what the hope is that we will achieve the sociable weaver bird scenario. It's also called the cooperation nation scenario. And that would see a collaboration between the private sector, civil society, and government in terms of growing our economy. Improving growth is going to be fundamental to the success of our economy. Job creation, increased industrialization, infrastructure development. We're seeing 1 trillion rand being invested in infrastructure in South Africa. The Department of Public Works wanting to turn South Africa into a construction site, and about getting people into jobs, employment, and foreign direct investment, the SOEs turning around. The only way that the cooperation nation scenario will be achieved is through collaboration and through improved foreign direct investment. And that's really the hope for South Africa going forward, is that we'll be able to turn things around. And with improved sentiment, we also need political consistency and certainty in South Africa, and that's why the GNU government is so essential, the stability of that, to an improvement in the economy. So as I said at the start, it's easy to focus on the negativity, on the bad things, and we can't be naive. We have to make sure that we're aware of these. You need to be educated. You need to make sure that you're following the news. But South Africa really can be that roller coaster where we hope on one day and despair on the next. And that's the reality. It sure as hell is not boring in South Africa. It's not as bad as you think it is. And we really are alive with possibilities. And there are so many possibilities for us to be investing in right now. Thank you very much.
Thank you, Mandy. That was truly inspiring. Next, I'll hand over to Evan Jankelowitz from Sesfikile Capital, Portfolio Manager of the Curate Momentum Flexible Property Fund. Thanks for joining us, Evan.
Thanks, Ray. So today we're going to speak about building value in a shifting landscape. So we all know the world that we're living is shifting more than it has, or it feels like it's shifting a lot more than it has in the recent past, with Trump, with tariffs, with geopolitics. And what you need to build a sturdy value building is many different diverse bricks. And that's what the Curate Flexible Property Fund does. It takes the JSE, where we have an amazing property sector, but we only have 601 billion rands worth of stock. I say only, it's still a lot of money, but we have that block which is shifted across not only South Africa, even though it's called our South African Property Funds, it's shifted over about 8-9 countries, but the bulk of it is in South Africa, and the next biggest block is CEE, Central and Eastern Europe, which is also emerging markets. It's a great sector, but it is somewhat limited. That's why in our fund, we decided to add onto that an exposure to developed property markets. So you're looking across 8 regions across the world, across the developed economy, which is really dominated by the US, which is over 60% of the allocation. Not only do you get those diversified bricks in building your building in different regions, but you also have a variety of sectors. Now, what you have in South Africa is you have 22 companies in the index. You've probably got another 10 more that are investable on the JSE. And you have really exposure to three main sectors. You have retail, which is about 60%, and then taking it to just over 90% is industrial and office as well. So it's not a bad thing. There are very good sectors, but they are really legacy sectors. If you look at the developed markets in our offshore allocation, you have over 11 sectors. We have over 340 companies across the world. So it's an amazing thing how you can diversify across, even within those 11 sectors. You can sub-diversify. So, for example, you have healthcare in the offshore exposure, but offshore exposure in healthcare is subdivided into skilled nursing facilities, old age homes, hospitals, medical office buildings, or what they like to refer to as mobs. You have a lot more choice. So what we like to do here is we like to build value on diversity and a lot of bricks, building that sturdiness in this very uncertain market. If you look at the kind of complementary factors of these two, call it exposures, local and offshore, obviously property across the board is very sensitive to interest rates, more so the long bonds. So they are very much aligned in that respect. So the lower rates are, as rates go lower, property does tend to do better because it's an opportunity cost to yielding instruments. So the lower bonds are, property looks better at that sturdy, stable yield. Also inflation, which is the underpin of the actual rental growth. So they're both linked to inflation and to interest rates. But where you do have that nice diversity coming through is you have, call it rand volatility. Living in South Africa, we all really have this nuance around where's the rand going, where's the currency on that front, and you don't have that globally. You have a variety of currencies, and they're not subject to what one or two individuals may say on the side. So you have that diversity across currency. You have that, political diversity as well. Again, living in South Africa, we know only too well about political instability. So that's a nice diversified factor as well. Not to say that there's no political instability globally, but at least it's call it a wider base. And the people aren't so sensitive, or the markets aren't as sensitive to that political instability. Geopolitics that we've seen, unfortunately, in recent times, South Africa generally has a little bit of a covering or some hedge towards that. So it's in favor of South Africa. And then sector diversity as well as regional diversity. That's why we add in the global or the developed market exposure to smooth it out. That's why, as a whole, it's a lot smoother ride in this, call it curate flexible property funds. And we've said that obviously global might be a little bit better because of that diversity across many more companies, many more sectors, many more regions. But South Africa has actually been doing very well. And we're going to speak about those local fundamentals in a moment. Okay, so we're speaking about the benefits of SA property, and it's really been a great, call it 18 months. The sector's done over 42% in the last 18 months. And many people are saying, well, is it too much too soon? And I'm saying no. So if you look at this graph over here, you've seen from the beginning of 2018 to where we are now, the sector is still down 39%. 39% ex distribution, but it's still down a lot. So what I'm trying to say is that even with this 42% rally, we are still down off the peaks. There was justification for it to come off the peak, but not to the extent that it did. Obviously, we had the likes of the hedge fund allegations towards certain of the companies. You had COVID coming through. You had the advent of work from home and online trading, which impacted retail. But the truth of the matter is, a lot of this correction that we've seen is because of stronger fundamentals. Post Eskom getting their story in order, post GNU coming through, there's been a lot of positives which not only corrected the market off a very low base, but have actually shown a steady growth going forward. So if you look at the last, call it the calendar year 2024, you had a really strong year. Last year it did 31%, or we did 31% in the local environment. And you can see the top performers were all South Africans. In fact, the actual weaker stocks were all offshore. So if you look at this graph over here, the orange stocks are the exposures to the global environment. So South Africa is where we saw the GNU and Eskom coming back online, and that's where you saw the growth. And that made a lot of sense. But we saw over and above that the other 40% exposure to our SAPI index underperformed, and it underperformed quite a bit, but there's no reason for that because those companies actually did very well. That's why at the beginning of this year, we had an overweight exposure to these companies, and they've come back very strong. So last year, it wasn't really a story of just bouncing off a low base, but we've actually seen the environment strengthen. And I want to speak about that in retail. Retail has been quite a long story. What we saw is coming into the the GFC, the global financial crisis, things were actually looking quite good in South Africa. You had the Mbeki years and you saw strong GDP growth. On the back of that, you saw a lot of foreign interest coming to launch different brands in South Africa, whether it was Zara, H&M, Cotton On, great success. So what happened is, as they showed interest, the big shopping malls wanted to build. So you saw Fourways Mall, Sandton City, Canal Walk, Menlyn, amongst many others, going beyond 100,000 square meters of space for retailers. They grew too big for what was on offer. Over and above that, as you hit the GFC, all of a sudden that demand fell off. A lot of those guys that wanted to come into South Africa, for example, Forever 21, have already left. So you had a lot of space being built, but the demand wasn't as strong as we thought. Over and above that, we saw some of the local brands coming under pressure, notably Stutterfords are gone. Edcon came under a lot of pressure and they have downsized considerably. So you saw a lot of weakness there. So you saw the supply and demand dynamics work against us. A lot of supply came through in the early 2010s and demand came off because we entered the Zuma years where GDP came under pressure. But the silver lining there is that there was very little new development coming through in subsequent years. And as it happened, you actually saw new demand coming through. So new entrants into the market, but also a lot of strength coming from the old stalwarts. Shoprite has been an amazing story. The likes of Boxer has grown quite a bit. So has the Foschini Group has expanded quite considerably, as well as brands like, Studio 88, Dis-Chem have taken space where 10, 15 years ago, they weren't taking any space. So the retail environment, because we've had very little supply and now we've got demand coming through, we are seeing that grow quite a bit. And we're seeing positive reversions coming into the market. If you look at what we've seen here, and the best indication of retail is what we call your effort ratio, rent to sales. So you can see that during COVID, it was a very high number, and high is bad in this case because you are paying a higher level of rent relative to the sales you are making in that store. But it's come all the way down to levels that we last saw in 2012, 2013, and they are very reasonable levels. That means there's a lot more affordability for the actual retailers to pay higher rents because they are seeing that footfall coming through. And why are they seeing that footfall coming through? Because we're in a lower inflationary environment, we're in a lower interest rate environment, and the likes of the government grants have been quite consistent, which has really underpinned the actual shopper in these malls. And there hasn't been an oversupply of new retail space since, call it 15 years ago. So it is quite a unique scenario that we're sitting in. And retail as a general pointer is actually quite strong at the moment. And you can see it at the vacancy level. In the market, according to SAPOA, our vacancies are only 3%, coming off obviously a very low number as well, 4.4%, but 3% is really more, call it tactical, moving shops from here to there. So it's not a very high number at all. So retail is still in a very good space. What isn't in a good space, but it is a better space than it was before, is office. And people always say to me, no, it's all about work from home. I personally don't believe in work from home to a large degree. I think people are social beings. They want to be around people. They want to learn. And I believe people have and are still going to come back into the office. The problem with office is it is really the bellwether for the broader economy. So as GDP has really flatlined over the last decade, you haven't seen any real demand for office. Granted, there's been very, very little supply, and you can see it at that bottom graph. Supply as a percentage of stock in the last 5, 6, 7 years has been, call it 1-2%. That is really no new supply coming through in the last, call it decade. But you still haven't seen demand coming through. It has got better. If you look at the vacancies on the top line there, vacancies are now are coming below the, call it 10-year, 15-year average, especially in prime grade office and especially in the Western Cape. So there are some green shoots coming through, but I'd like to say, or not get ahead of myself, it is better, but it is still not good. What is very good is logistics. And it's an amazing story because, they used to be the laggard of the sector, used to have a lot of supply historically because generally they used to be sheds. Boxes on a piece of land. We never had huge restrictions in South Africa, and you could build pretty much wherever and whenever. So there used to be a bulk of supply, and what you saw subsequent to that is that you saw this online boom, and that was one of the initial pushes there. Online, people needed more space for reverse logistics, and you saw a lot more demand coming through in that regard. And you saw rentals chasing that as well. So I'll give you an example. In 2008, pre-listing, Equites was signing 38 rand a square meter at a 10% yield, and that kind of made sense then. Now you're getting similar builds for 85 to 90 rand a square meter, and you're only at that rental, you're only yielding circa 8%. So what is it telling you? The market has completely changed. Why? Is because regulation is limiting the space usage. You've got to be in prime locations. Building costs are higher, so there's not as much supply coming through. But also, as I spoke about that before, is that online trading, online retail is a huge demand driver for logistics and warehousing. Not only that, is historically used to have just-in-time retailing. People wanted to make sure that they save costs, get the stock there, put it into the store and sell it as quickly as possible. But because we've seen so many disruptions in global pipelines, whether it's from geopolitical issues on the sea, whether it's because of Transnet issues, people need just-in-case supplies. So you're seeing a lot more warehouse usage, and that is really creating a lot more demand for the industrial sector as a whole. Okay, so if I just speak about the revenue line, it's a little bit unfair. I've got to speak about costs as well. And you can see in the last 10 years, costs as a percentage of revenue have sparked circa 8%, both on a gross basis as well as on a net basis. And the large contributor to this is something we all know, the cost of energy. The cost of electricity has really gone through the roof. Over and above that, municipal costs have also sparked quite considerably. So that has been a laggard in recent years. Obviously, I spoke about the last 2 years being very strong in property, but before that, from 2017 all the way to call it 2022, property was really on a downward spiral. And also because of earnings were under pressure, because of this high cost base, as we needed to use diesel, as we weren't being able to operate because of the load shedding. Thankfully, load shedding is, I'm hoping, a thing of the past at the moment. But not only that, again, I speak about silver linings. During those bad years or those dark times, a lot of these landlords developed or rolled out huge platforms of renewables, mostly solar, battery usage as well. And you can see in the last year or so that the actual cost ratios have come down. Why is that? Is because they are able to get off the grid. They're not dependent solely on paying Eskom. They've got these renewables in play and they're very, very cheap. Not only that, is that they are able to kind of get the tenants to pay for it as well, and they pay a higher rate than it costs them to develop that energy, but lower than they would be paying to Eskom. So speaking about renewables and where we are at the moment, 17% of all energy use across the listed sector is already serviced by renewables. So where we were paying a rate per megawatt, now we are paying zero because it is a sunk cost. Over and above that, these guys have not stopped. We hope to get to 25 to 30% in the medium to short term of all energy consumption coming through from renewables. And that would be a great benefit to a lower cost base, meaning a higher net profit, meaning higher distributions and higher value for you. If we go into, and I already spoke about the South African aspect of the South African property funds, but if we speak about the exposure to CE and to the UK as well, which are really the biggest components of the offshore component of the SAPI, you can see they've already done well as well. So when we look at CE and Europe, generally it's retail, and we've seen discretionary spend increase quite a bit in the UK as well as in Europe. Why? It's because inflation rates have been low, interest costs have been low, and discretionary spend has been higher. So the likes of Nepi, the likes of Mass, operationally have been very, very strong. Even if you look in the UK, Hammerson, after selling bulks of their portfolio in order to strengthen their balance sheet, as well as Capital and Counties, which have really the prime assets in London, have also shown growth in spend on their portfolios. So those stocks have also been doing exceptionally well. We do have a little bit of diversity in that, call it European space. The likes of Assura and PHP are really kind of clinics, medical buildings that are really underpinned by the UK government, and they are very kind of rock solid cash flows that come through as well. And then lastly, Sirius. Sirius is an amazing company. It's more operational than it is bricks and mortar, but it's really a formula that has been working over the last 15 years. Day in, day out, they have never shown any decline in earnings, even through the COVID years. So our exposure, albeit somewhat limited, in the South African component of our property sector is very, very strong. Now we're going to look at the global themes and I'm speaking about the global developed market themes, and we'll go into 3 stories that I really like to tell you. The first theme I really want to speak about is tech. You've seen the big tech expenditure increasing by over 60% from 2004. It's been an amazing growth cycle. If you look at what we consume every single day, is that whether it's the cloud consumption, whether it's streaming of Netflix, and now ChatGPT, and what does this really flow into? It's the use, it's the requirement for data. And you've got to store it somewhere. So one of the big themes that we've played over the recent years is data centers. You've got to store it. Even though we speak about the cloud is in a server in a big building. So we can see the demand for the space. And this space is not just building a box. It has to have access to a lot of power. It has to be very strategically situated as well. So what we've seen in recent years is that you've seen a lot of demands, but as AI has come on stream now, and AI requires a lot more processing power than streaming or than cloud computing. So you can see a huge rally in the actual rentals, and because of their consumption in the recent couple of years, both on what we call hyperscalers and co-location. Hyperscalers are the very dominant Amazons, Googles of the world, where your co-locations are smaller enterprises. So you ask yourself, why historically weren't rentals that aggressive? Because the hyperscalers were very dominant. They could price you down and further down as a data center provider. But now where we are, because of the huge demand for space, because of the advent of AI, you saw rentals really spark. And that's a recent spark, and we're very happy with it. But we still see inflation plus growth in the short to medium term as well. So we are still very buoyant and very, positive on data centers, although not as quite as positive as we were before, because we are coming off the peaks with regards to growth. But it is still a space to watch very carefully. The other theme we want to look at is kind of the other end of the spectrum. So we're speaking about big tech, about data, and now we're speaking about something very, very different. It's necessity-based, and we're speaking about older people that need hospitals, they need healthcare, they need retirement facilities. So what we're seeing now with regards to the demographics, especially in the US, is the baby boomers have reached, not are reaching, they're really in the prime of their twilight years. There's a huge requirement for nursing facilities, for old age homes, and you can see that demand is really picking up. However, subsequent to that is that what we've seen is we saw a lot of supply, but it has come down quite aggressively. Why? It's because enhanced regulation, higher building costs as well. We're really in a perfect sweet spot where there's a great demand for the product and very little supply, and we've seen a huge amount of growth in this space. This is a space where I think that we are very firm. We haven't seen a slowdown here at all. Some of the best companies globally, one in particular is Welltower, has really played to this theme and is really doing exceptionally well. The last of the themes I want to speak about is retail. And it doesn't seem as creative as data centers or older people or with regards to skilled nursing facilities and the likes. But this is a theme that we really speak about, is that it's coming back into vogue. During COVID and just before COVID, when people were speaking about online retailing, people thought the mall is dead. We saw many headlines saying people will never go to a shopping center again because they can buy what they need online. Something I referred to before, we are social animals. We want to see, feel, touch. We want to be involved with each other. There's still entertainment. There's still restaurants. People want to be in the mall. And we've seen that come back in a big way. So where these things were, during the call it the poor years, the bad years, there wasn't any new supply that came through because people believed in that scenario that the mall is dead. The banks wouldn't give any funding. So what you saw is very little supply. But what we've seen subsequent to that is people have realized, or more so the retailers have realized, you can't trade online alone because the margins aren't strong enough and you aren't, attaching or attacking all your relevant markets. So what we've seen is the demand for retail space has come back in a big way. Supply has been very low, and you've actually seen a lot of creative brands playing the omni-channel play, playing the, call it social interactive play as well, and has really led to a tailwind for big retail as well. So we've spoken about the fundamentals, both locally and abroad, but now we're going to speak about value. So we know what we're buying, but are we buying at the right price? So when we speak about local value, we always look relative to the long bonds. So this graph over here shows you the property yields divided by your bond yields, And the higher it is, the cheaper it is, and the lower it is, the more expensive it is. It is actually looking at decent value relative to the last 20 years. Yes, it was very cheap during the COVID years, but that was a very unique time where we actually had no idea where earnings or how sustainable earnings would be from there. So where we are now, we're seeing it justifiably, has re-rated, but still cheap relative to its history, but also relative to its growth. That blue line there is the inverse, or they call it the square line. There is the inverse of growth, and growth is getting stronger. Therefore, your rating relative to bonds should be getting stronger as well. Not only are you getting a nice cash flow yield out of the property, but you are also getting great valuation on an asset base. We are still trading below one standard deviation to the NAV over the last 15 years. We're still trading at about a 24% discounts to NAV. We are seeing, and I've seen in the last 3-4 years, 4 to 5 billion rands worth of transactions at NAV. So why should we be trading at such a deep discount to NAV? Well, we shouldn't. So we believe that there's still value in the sector. So now let's speak about global valuations as well. It's also looking reasonable value. The long-term history, or call it the last 10 years, it's been about a 17 multiple. And at the moment, we're at about a 15.9 multiple, which is cheaper than the recent history, but it is not really indicative of growth, because growth is picking up as well. And also, if you look at our discounts to NAV, similar to SA, is trading at quite a healthy discount to NAV. The only ones that are trading at premiums to NAV, your net asset value, is healthcare and data centers, which I spoke about before. But there's a reason for that. It's because growth is more exponential than the other sectors. So we expect these asset values to increase and catch up to those, or the NAVs to catch up to the recent pricing as well. So value on a cash flow basis, or a multiple, is looking attractive, and also as a whole, the sector is also trading at quite a healthy discount to NAV. And let's go finally to see what this combination of local and global has done. Well, historically, and it's not a long history, admittedly, but over the last year, we have outperformed the sector, and the sector, or our benchmark, is 60% is exposed to the all property index, and 40% is exposed to the global market index. If you look at it, since inception, we've outperformed quite considerably, and even year to date. But really what I want to point out is not our performance. I want to see what your performance is and what the benefits of the sector is. So the global sector hasn't done as well as the local in the recent 12 months. It's actually done considerably worse than local property. Property locally has been exceptional, but you get that balance. We're not here to take a chance, take a bet on any particular asset, any particular subsector. We're here to give you a diversified product, which we believe gives you the opportunity to outperform through the good years as well as the bad years. Very fortunate we've had a very strong market in South Africa to balance out the weakness we've seen globally, but we think going forward, we'll see strength in the global market. South Africa will normalize. We still see their value there, but we believe that this combination gives you the ability to outperform on a balanced basis. Thank you very much for that. With that said, I thank you very much for your time, and speak about why Sesfikile. Well, we eat, sleep, and breathe property. It's owner managed. This is the reason we come to work in the morning. This is the reason we wake up in the morning. And the one thing that we can promise you is that I can't promise you that we'll beat the benchmark going forward. But what I can promise you is that the process is the same, that we've beaten the benchmark in the last 15 years. And that is the process that we'll be delivering for you going forward. Thank you very much.
Thank you for those great insights, Evan. To summarize, the Curate Momentum Flexible Property Fund provides investors with a compelling solution for long-term wealth creation. It is managed by a specialist property manager with a flexible mandate that spans both local and global listed property markets. This broader investment universe significantly enhances the opportunity set. In South Africa today, around 90% of property mandates are restricted to local assets only, giving exposure to only 20 listed property companies. By contrast, the Curate Momentum Flexible Property Fund can access property markets across 8 additional global regions, expanding the investable universe to nearly 350 opportunities. This wider scope allows the team to identify value, capture growth, and add to overall returns. As Evan highlighted, the strategy combines deep analysis of South African fundamentals with key global property themes. This dual focus, together with diversification across local and international markets, helps reduce risk while positioning the fund to take advantage of both domestic and global possibilities. Our next speakers are portfolio managers from Momentum Asset Management, Zisanda Gila and Tami Lesito. They'll be talking about how to find opportunity in times of volatility.
Thank you, Ray. Good day. My name is Zisanda Gila, Head of Money Markets at Momentum Asset Management.
And I'm Tama Felicito, Senior Portfolio Manager at Momentum Asset Management.
Oftentimes, volatility is viewed as uncertainty, risk, or even fear. But what if it is not something to fear, but something to embrace, leverage off, and profit from? What if it is the very thing that unlocks opportunities others cannot see or are brave enough to act on? In volatile markets, the surface can be chaotic, but underneath it is often lined with patterns that help us analyze, signals that help us navigate and find opportunities in chaos. Managing funds in volatile markets requires one to separate the noise from the signals, as Tamu would agree. Right, Tami?
Z, I agree. Volatility is part of markets. Volatilities have always been in the markets. They will continue to be in the markets. But what we need to understand is that volatilities bring opportunities. And we as fixed income professionals are always there to help our clients navigate volatile markets, number one. And number two, also extract potential return for them in volatile markets.
We then start by embracing the volatility. As uncomfortable as it often feels, the reality is that in volatile markets, the biggest advantage isn't access to capital or access to information. It is the psychological edge. The art of mastering your mind, which enables you to navigate the markets and uncover these unseen opportunities. It is the advantage that you as an investor gain by mastering your own emotions, biases, and decision-making under uncertainty. It is about behaving rationally when others are reacting emotionally. While severe downturns naturally evoke panic with investors, history shows that markets eventually stabilize. And keeping calm while others panic may not be the easiest thing to do, but it usually presents golden opportunities that they might miss. One of the best ways to tune out the market noise is to stick to the basics, guided by sound investment strategy. It is when you are clear on your goals, your risk tolerance, and asset allocation that the day-to-day turbulence becomes easier to navigate.
Whether we look at the global financial crisis in 2008, the COVID-19 sell-off of 2020, local sovereign credit downgrades, local political uncertainties, or even the recent market shock from Liberation Day, and oh, what a day it was for the markets, the pattern has been consistent. While each of these events triggered extreme volatility, panic selling and record outflows, it also presented buying opportunities, where many quality assets were mispriced due to emotions rather than fundamentals and valuations. These periods were followed by recovery, which some are often stronger and faster than expected, like the V-shaped recovery we saw during COVID-19. That makes us conclude market reactions are often emotional, short-lived, and that recovery is a recurring pattern. And I think I'd like to emphasize that to our investors. Markets always come back. They will, as I'd said earlier, there will always be volatility. We will still have volatility in the markets. We've always had volatility. But the one thing to always remember is that markets often and always have recovered in the past. The 2008 global financial crisis was a stark reminder of how fast markets can unravel and how easily fear can drive decisions. Triggered by the collapse of the US housing market and the failure of major financial institutions due to the excessive exposure to subprime mortgage debt. Globally, it led to a severe credit crunch, stock market crashes, and economic contraction. Many investors panicked, pulled out of investments, and their strategies turned into survival mode. Locally, the JSE experienced significant declines during this period, and the rand depreciated sharply, losing about 35% of its value against the dollar at one point. On October 15, 2008, the Dow Jones Industrial Average Index sank 7.9%, while the JSE All-Share Index lost 7% in one day. Over the crisis, South Africa's financial institutions remained relatively stable due to the conservative banking regulations, and the anticipated contagion effect did not materialize. The few investors who stayed invested, trusting their long-term strategy, be it by choice or the inability to liquidate their assets, recovered after the noise had settled. Those who spotted opportunity amongst the fear and panic profited handsomely. Z, tell us how you behaved during 2008 as an investment manager.
So the trick was we remained calm and stayed invested.
Well done.
The 2015 Nenegate crisis in South Africa is a perfect example of how emotions drive market moves in the short term and how investors with discipline benefited in the medium to long run. The local currency also plunged 10% within days to record lows. Bond yields sold off 1% overnight and remained volatile for weeks following the event. Jobs were lost. The JSE lost billions in market cap and investor confidence collapsed. Again, these movements reflected investor panic. The sell-off was driven more by emotion than by fundamentals in some sectors. Investors dumped stocks, while bond investors demanded a higher political risk premium for their bond holdings, which further amplified the volatility. Nenegate showed us that markets can overreact to political shocks. Investors who lacked psychological edge sold into fear and crystallized losses, while those with discipline of staying invested and a long-term lens weathered the storm and saw recovery. Volatility is inevitable, but investor psychology is important in determining whether it destroys or creates value during those times.
The COVID-19 sell-off of 2020 was one of the fastest and most severe global market crashes in history, but also one of the fastest recoveries. When one thinks of the COVID-19 sell-off, V-shaped recovery always comes to mind. The pandemic triggered global economic shutdown, leading to panic selling across markets. Investors were so desperate for cash that they sold everything, including traditional safe assets. It was a liquidity crisis and a flight to cash or low-risk assets. Cash became king in the hands of investors during this period. This event created abnormal volatility and dysfunction in bond markets. Bond yields in South Africa rose due to foreign outflows and lack of buyers. 19 March 2020 saw the South African 30-year government bond close the day at a yield of 12.9%, almost 13%. Central banks, including the South African Reserve Bank, intervened and implemented aggressive monetary easing through rate cuts and liquidity injections to stabilize financial markets. As the markets rebounded, those who stayed invested or bought during the lows saw strong returns, and those that saw opportunity once again profited. South Africa's downgrade to sub-investment grade or junk status was not triggered by a single event, but rather a culmination of fiscal erosion, political instability, state capture concerns, and growing pressure from failing state-owned entities. S&P's downgrade to junk status in April 2017 was preceded by a number of own goals scored by the South African government, but mostly by mismanagement of finances of the government and state-owned entities. The market reaction was significant. Capital outflows, exclusion from the global bond indices, the WIGB, a weak currency, and higher borrowing costs, all of which constrained our fiscal space. Over time, what started as panic selling by institutional investors gradually shifted towards more selective, risk-aware re-entry as certain investors sought to identify mispriced opportunities in the South African market. An event that seemed to us local fixed income investors as the end of any participation by foreign investors in our local government bond market turned out to be just another volatile period that required one to be measured and once again separate the noise from the signal, which I guess, Z, is what you were talking about earlier.
Yes, exactly. As investors, you need to cut through the noise. That brings us to our next market event that shocked the markets. The tariff shocks that were announced in April 2025 triggered an upright and broad-based volatility across the various asset classes, underscoring heightened investor sensitivity to policy risk. In South Africa, the rand depreciated sharply, bond yields spiked, and business sentiment deteriorated as concerns over export exposure mounted. Our forward rate curves tracked the US Fed Fund futures, which implied a more aggressive rate cutting path at increased fear of recession. The one-year swap point rallied a lot, fully discounting future rate cuts. For active managers, this dislocation created opportunities to reposition portfolios by exploiting mispricings in the various curves and locking in higher yields. In global markets, the US tariff stance amplified inflation fears, clouded the Federal Reserve's rate trajectory, and intensified risk-off flows into safe haven assets. This episode highlighted how rapidly shifting trade policies can reprice risk across asset classes, particularly in emerging markets with concentrated trade linkages. Investor reactions showed a familiar path of initial risk aversion and flight to safety, which was then followed by a more measured approach as the market began to price in the longer-term implications of the tariff measures. Funds like the Curate Momentum Enhanced Yield Fund are well positioned to navigate such environments, using active income strategies to seek enhanced returns while maintaining disciplined risk management. With the bond market under pressure during this period, short-term opportunities emerged, allowing us to restructure positions and lock in attractive yields. The fund has remained resilient through these market events due to the team's investment philosophy of active investment research supported by disciplined investing and robust risk management processes. In the wake of recent market volatility, we have actively hunted for yield-enhancing investments across the various curves, structuring notes that optimize the risk-adjusted returns while maintaining liquidity and capital preservation. By carefully analyzing the market dislocations, we were able to identify opportunities where uncertainty drove the bond market, creating repack opportunities and at wider spreads. It is this discipline and data-driven approach that has allowed us to remain invested when many were exiting the market, turning volatility into a source of potential upside. Ultimately, our strategy combines active risk management with a psychological edge, the ability to act rationally when others react emotionally, positioning our portfolios to capture the opportunities that emerge in turbulent markets on a risk-adjusted basis. The Curate Momentum Enhanced Yield Fund is designed for investors with a moderate risk appetite who are seeking enhanced returns through active income strategies. It offers slightly higher risk and return potential than a traditional core money market fund. It takes a more active approach, aiming to enhance yield through diversified income-generating assets while still managing the downside risks.
Investors with long-term perspective, short-term market volatility is a distraction that is better off ignored. It is important to look through the noise and stay focused on the big picture rather than reacting emotionally to daily market movements. The Curate Momentum Flexible Income Fund offers its investors stable returns even in times of volatility because of diversification across asset classes and our ability to assess valuations and trade in and out of positions as and when we see fit. The Curate Momentum Flexible Income Fund truly lives up to its name by offering investors the flexibility to earn stable income across various asset classes even during times of heightened volatility. Staying invested during the time of market volatility has consistently proven to be a sound and rewarding investment approach, as myself and my colleague Sisanda have shown during this presentation. By maintaining adequate liquidity, investors are well positioned to capitalize on opportunities arising from market dislocations, particularly when other participants are compelled to sell assets at distressed prices. We have recently seen, as highlighted by Yuzi, during the recent April tariff crisis, how certain assets were selling off despite their valuations still making sense.
That's correct, Tommy.
Looking ahead, markets remain unsettled by ongoing tariff disputes and persistent local political uncertainty. These factors continue to contribute to heightened volatility and uneven performance across asset classes. In a volatile environment, maintaining a selective and flexible investment approach is crucial, and most important is staying invested. Implementing strategies that emphasize active risk management and focus on identifying mispricing opportunities. The Curate Momentum Income Plus Fund aims to deliver high stable income by investing mainly in debt instruments such as corporate bonds, banks, and other insurers. It targets returns above cash and cash equivalents like money market or bank deposits and can be used as a portion of an income-generating portfolio. The main priority of the fund is capital preservation as well as delivering uncorrelated returns. The type of assets this portfolio invests in allows it to still perform even when equities and bonds are having a tough time. As we have demonstrated, there's golden opportunities in financial markets.
And our team is positioned to deliver on our clients' financial dreams.
Thank you for your time.
Thank you.
Thank you, Z and Tammy. The Curate fixed income funds are designed to meet different investor needs. The Curate Momentum Enhanced Yield Fund addresses liquidity requirements, while the Curate Momentum Flexible Income and Income Plus funds focus on delivering clients' income requirements. The team takes a valuation-driven approach and, as highlighted by the portfolio managers, navigates volatile markets with a strong quality overlay. The proof is in the performance. The Curate Momentum Income Plus fund celebrated a huge milestone last quarter. The fund turned 20 years old. For 2 decades, the fund has demonstrated its ability to deliver stable, high-quality returns across a wide range of market conditions. It offers a compelling combination of consistency in returns, quality of underlying instruments, and diversification benefits that remain as relevant today as they were at inception. The fund is designed to deliver a high level of income with low capital volatility, and it has done exactly that. Since inception, the fund has delivered 229 positive return months out of 240, highlighting an extraordinary level of consistency. In addition to its consistency and disciplined construction, the Curate Momentum Income Plus fund behaves differently from other traditional asset classes, providing meaningful diversification with multi-asset class funds. This reduces overall fund risk while helping to smooth return outcomes. Once again, a noteworthy achievement. On that positive note, we conclude our Exhibiting Our Investment Artists webinar. We know how valuable your time is, and we thank you for joining us today. We hope that you have drawn inspiration from this webinar. Please complete our survey that will be sent to you immediately after this event, as your feedback will help us shape the event going forward. Until next time, goodbye, and thank you for trusting us with your clients' money.